Welcome. I am Karen Holden. I'm a member of the Committee for Financial Matters and Retirement, which brings you this program. So I'm delighted to introduce J. Michael Collins to you today. Michael is professor in the School of Public Affairs, the Follett School of Public Affairs, and is also the Fetzer Family Chair in Consumer Science and Personal Finance in the School of Human Ecology. He now heads the UW-Madison Center for Financial Security, which started very shortly after he arrived. He really plunged into the work when he arrived in Madison in 2008 and has grown under his guidance. This is a multidisciplinary research center which has developed and grown tremendously in these years, and was recently designated a Social Security Administration Retirement and Disability Research Consortium Center, one of four in the United States. Both his work and that of the Center for Financial Security focus on financially vulnerable populations. That has always been the focus of the center. And includes the role of public policy, or primarily the role of public policy in influencing credit, savings, housing, and investment choices for both the young and old. And he has done a lot of work on young student debt and consuming behavior, as well as the use of credit and debt by the elderly. Let me also add that Michael is widely credited for bringing rigorous evaluations to this field, and so he's really led this field in understanding, having good data to understand why and what works in the school, in the field of financial literacy. I think I've said enough nice words about Michael. I will say that he's a former colleague of mine. I'm a former colleague of his, let me say, in both at the Follett School of Public Affairs and Consumer Science. And so I'm delighted to introduce him to you, and let's get on with talking about financial security and well-being in retirement.
Great, thank you. Thank you, Karen. I probably wouldn't be here in Wisconsin if it weren't for Karen. So thanks for helping recruit me to be here and all the support over the years that we were together. Yeah, very good. So as Karen said, we'll talk about this idea of well-being in retirement. And I'm going to start with some sort of bigger picture issues around how we think about well-being, financial literacy, financial capability, and how these things interact to help people subjectively feel well in terms of their finances, really at all phases of life, but especially in retirement. And then to the second half of the presentation is really more around sort of policy issues, particularly Social Security, Medicare, Medicaid. So we'll break right before that policy discussion and sort of after that policy discussion have an open discussion, which I really relish. In the meantime, as I'm going through slides, if there's something you didn't hear me say right, or I use a term and you're like, I don't know what that is, feel free to ask me clarifying questions, but we'll kind of hold the real discussion till after the break and after that second half. So hopefully that works for everyone. Again, Karen mentioned that we are funded by the Social Security Administration. We're funded also by Treasury and a few other agencies. Everything I'm saying today is just me. I'm not speaking on behalf of the center or UW-Madison or any of these funders as well, and I'll make that disclaimer again at the end. But especially working with federal funders, they're very skittish about talking about policy issues. So I will be really just speaking here on my own behalf. And if I say anything in the Q&A, it's recorded. It's me, not someone else. All right, so let's talk about this idea of financial security. We are the Center for Financial Security, and that name is actually carefully chosen. I mean, we're not the Center for Wealth Accumulation. We're not the Center for financial success. It's this idea of security, of avoiding fragility, avoiding vulnerability, and having people feel secure. So that might mean having a lot of money. Maybe that's what makes people feel secure. We also see people who have a lot of money and don't feel secure, right? So it's beyond just these, measures of income or wealth. And we worry about financial security for everyone, even people who, perhaps don't have a particularly high earnings trajectory through their lifetime. So really thinking about that concept and how that relates to well-being and, how people feel about their finances. And so we'll sort of start from the individual and work our way up in the second half of the presentation, thinking more about policy. All right, so let me just talk a little bit about this, what we call life course approach when we think about financial well-being. And at this version up here, we start with age 16. We've actually had work that starts even earlier, even preschool. Work where we try to think about what does it mean when a parent reads books to their 4 or 5-year-old about money issues. So there's actually a Curious George book where Curious George is trying to save up to be able to buy something. And, all these temptations to spend the money and how rewarding it was for him to be able to buy the thing that he wanted. And there's other books like that are out there. And so you can think about really this life course beginning with parents interacting with their kids at the store or in reading or whatever. So lots of different ways we can think about that. We have a couple of studies we did with 10-year-olds, 4th and 5th graders, who had bank accounts at their school. And by bank accounts, I mean like a folding table with a 6th grader who took money in little pouches, little zippered pouches, like nickels and dimes at a time. So, a bank at a school, but what kind of experience did that have kids experience? In high school, we've done a lot of studies of what's been the effect of states that have implemented a mandate that before you can graduate, you have to take a financial literacy course, which Wisconsin will, I think in 2 years, have in place. Every kid who graduates in 2022 or beyond has to have a financial literacy class, so we've studied that. So anyway, there's a lot of research that we can look at earlier in life, but I'm really gonna start with around age 16. And why do we often start there? Because that's about the time you start really becoming a little more financially independent. By that I mean you might earn some money, you might have an account in your own name, and you're making decisions about how you're spending that money a little bit more, beyond just lunch money or allowance that you might get at a younger age. So we think about those decisions that young adults make. It turns out that that 18 to 19 threshold means a lot legally, but in terms of people's financial decision making, means very little. 18, 19, 20-year-olds make a lot of financial mistakes. If we look at credit bureau data, 18, 19, 20-year-olds, about 1 in 3, and actually it can be as many as 4 out of 5, have a 90-day late payment, right? And it's not that they didn't have probably the money to do it, they just weren't paying attention to how to manage their money, right? And so, we see a lot of mistakes early in life that young adults make. Now, sometimes these are big mistakes, it's a car, a student loan, sometimes it's a small mistake, a cell phone bill, or, a credit card. But we see lots of those examples. So 19 to 25 is kind of a tumultuous time for a lot of young people. They're making financial mistakes. Hopefully they're learning from those. That school of hard knocks matters. And they start to get sort of righted. But a lot of younger people in their early 20s feel financially very, very vulnerable. They tend to have more debt. They tend to have very variable income. They don't manage expenses very well. They're worried about due dates. Plus, they're trying to figure out the rest of their life, their social parts of their life. They're dating. They're maybe mingling money with roommates and housing's expensive. They live in places that are expensive. There's just lots of rough issues when you're in those ages. So where we sort of think about things stabilizing a little bit is in those mid-20s, like 26 or so. People tend to be more stable in their employment by that point, a little more stable in their housing, maybe a little more stable in their relationships, so they start to be married or cohabitating or have other kinds of backup. So it's also when people start having families, maybe start buying a home, start buying a car, maybe even starting planning for retirement, or at least saving for retirement. And then we get to this sort of peak working age, 40 to 65. So financially, this is where a lot happens. A lot of people really don't save much for retirement until age 40 or so. They're catching up on student loans, they're paying off their mortgage, they're having kids, they're maybe churning through jobs. Just a lot of financial dynamics that happen in the 30s up until but about age 40, things start to stabilize. People start to be closing in on their peak earning years. Their incomes are rising and rising and rising. If the case where somebody has stayed home from work, maybe to do some childcare, they're starting to re-enter the workforce. So as a couple, you start to see rising incomes. So we see a lot going on in that 40 to 65 kind of range. We see a lot of people really kickstart their saving for retirement at age 50. That's really where people kick in. Now we have there's some reasons for that. We have some tax incentives that allow you to save more at age 50. We have other kinds of things that encourage savings at age 50. But that's really where people double down and start to save a lot. There are a lot of people who approach retirement 20 years out with really no plan who get it together. There are other people who approach retirement with no plan and 20 years later haven't gotten it together. And so we'll talk a little bit about what distinguishes those two groups. Then we get towards, somewhere in the 60s. It really varies, right? It could be early 60s for some. It could be later 60s or even 70s for others, where we don't really think about retirement the same way we used to in a lot of our research. We think about these retirement transitions. Because as you know, many people call it quits, right? It's January 1st, I'm done, I'm not gonna work again. That's one way to be. But we see a lot of people who maybe call it quits, and then a month later they start to dabble a little bit and do some side work, or maybe go back part-time, or maybe instead of calling it quits, they go down a little bit and a little bit and a little bit, and they sort of, they're working maybe 2 days a week instead of working 5 days a week. So it's really a retirement transitions kind of thing. You probably also know people who were bored, right? And they didn't need to go back to work, but they chose to go back to work, maybe doing something totally different. So it's not the kind of clear break where people walk away from the workforce and they're done. It's a much more gradual transition. But in the 70s, we tend to see most people moving away from work in the labor market and starting to draw down whatever assets they've accumulated. We call this decumulation, which I know is probably not the most favorable term, but they sort of are sort of reaping the rewards of that preparation for retirement. This is not always true. I chair the tax sheltered annuity board for the Wisconsin system. So we have the UW system and all the employees who are in the TIA craft for those kinds of the 403B plans. We have at least one member who's in his 80s and still working and still contributing. So there are certainly people who are out there who are continuing to save and work well into older ages, but certainly not very common, especially after sort of those early 70s. So this is a sort of life course approach. And I think one of the things when we talk about retirement or retirement planning is you have to be really careful about where people are in this process. It affects everyone, so even people in their 20s can begin to think about retirement and what that means. And decisions they make then can really be a factor for them later in life. It also affects people who are in this decumulation phase, planning for how I'm going to spend down assets. Maybe I think I have more than I need, and I want to think about legacy planning and think about how I'm going to manage all that. Maybe I'm happy with the amount of money I have, but I want to have a more stability in how I draw it down, right? So there's lots of different ways we can think about that. So we tend to think about this sort of three-legged stool of financial security. And this is probably a tired metaphor. You've probably heard three-legged stools on any number of different topics, so I apologize for that. But basically it's three different pieces. One is what you know. We call this financial literacy. Literacy is not the best metaphor, frankly. It's used all the time. Literacy makes a lot of sense when you're thinking about reading and writing literacy, because once you learn the letters and you learn the sounds and you learn the phonetics, you can sort of apply that and grow over time. Financial literacy, it's almost as if we're introducing occasionally new letters or new sounds, right? So it's because we change the product mix that's out there. We have policy changes. We have things that change in the marketplace. And so it's not just being literate once, like a vaccine, and you're good for the rest of your life. It's really being literate and aware and capable and able to adapt as things change. And that's really what we mean by financial literacy. But knowing information, knowing how to get information, knowing enough to know what you don't know so you can find more information, that's all the things that we think about for financial literacy. The second stool is financial capability. So, and this may strike a nerve with people or in your own life, where you know what to do, but you sit on your hands and don't do anything. And so that could be for a bunch of reasons. One is there may be people around you who don't help you do that. And maybe you just don't have the confidence. You're just not sure. Like, should I do this? Should I not do this? I know I have that all the time when I'm thinking about some of my financial decisions. I could do this, but I'm not sure if this is the right time. I'll just sit it out and not. So we sort of have this issue, all of us, of how confident we are in our skills and when do we really decide what to do, and how strongly do we feel like it's the right time or not the right time, those kinds of things. And this really has a lot more to do with our well-being, our sort of subjective sense of how we're doing financially. It's not about necessarily dollars and cents. So dollars and cents might make you feel more well financially, but it might not make you feel more well financially. You might feel stress about the decisions that you make or the kinds of things you have to do. So, connected to this idea of capability, the ability to act, the ability to apply that knowledge you have, is this idea of, do you feel okay? Do you feel secure? And I'll talk a bit more about that. And also feeling resilient. Could you, if you know that a bad thing could happen, could you handle it if it happened? Then the last leg of the stool is access and tools. And this is if you've ever come across somebody from the financial planning industry, especially somebody in sales, there's only one leg to their stool. And that's I have a product for you, whether it's insurance or savings or whatever. And frankly, policymakers aren't that much different. Look at some of the candidates for office right now and what they're proposing in terms of retirement plan. It's never a magic bullet, but it is a leg of the stool, right? So we do have to think about the combinations of what people know, what people are able to do, how they feel about it, and then what tools they have. Certainly not having access to a retirement plan is a major barrier for a lot of people. I'm now on the governor's task force on retirement. And that's one of the things we're thinking about. About half of workers in this state have an employer who doesn't offer a plan. That lack of financial access means that they're unlikely to ever start saving for retirement, at least not through work, which is the main way that most people do save for retirement. So access really does matter, but it's not a silver bullet, right? So we have to think about that too. But the other thing I would put in there, financial access and tools, is our programs like the Social Safety Net and Social Security. Our social insurance programs are a tool. You pay into them through your FICA when you're working, and you rely on them in terms of disability and retirement at later in life, or at any point in life. All right, so let me start with this idea of financial literacy. When I talk to people, students even, or regular people even, about financial stuff, pretty quickly their eyes glaze over, and it's as if I'm displaying some, this is some random collection of, maybe some of you in this room actually know what these equations are, but I don't. And so I think that's oftentimes what happens when we talk about financial issues with people, is they just sort of say, I don't care about risk and diversity, and I don't care, and so it's just painful for some people to have to think about how to allocate their portfolio or which fund to choose or whatever. So there is really value in people feeling okay enough with financial decision making that when they start to hear financial issues, they don't start to just glaze over, and this isn't what their perception is. We have a survey that is done every 2 years by FINRA. FINRA is the national regulator for securities dealers, right? So they have a strong interest in making sure that the consumer has knowledge about what's going on in the community or in the financial marketplace. And so they ask these really 5 basic questions about financial literacy. So it's things like, if you put $100 in a bank account and it accrues interest at 2% per year, after a year, will you have more or less than $102 in your account, right? So can you think about compounding? And even if you can't do the math, it's going to be a little bit more than $2, right? So those kinds of things. If you have a rate of return on an account of 2% and inflation is at 3%, will you be able to buy more or less with your money in the future, right? Pretty, intuitive kind of things. You don't have to have a lot of numeracy. You don't have to be able to do heavy math to solve these problems. And we see people in the sort of silent generation, so people born before roughly 45, 48, they get 4 1/3 of these questions. There's 5 questions total correct. Pretty good. That would be a solid, at least a B, if not an A, right, on any kind of test. The baby boomer generation, also pretty good. 4 out of 5, a little more than 4 out of 5 questions correct. Gen X, these are people born, roughly 65 to 1980-ish, right? Somewhere in that period. A little bit lower, but, still above passing. Millennials get just over 3 out of 5 correct. I would call that a failing grade. And then Gen Z, these are people born in the last 20 years, tend to do very poorly. And if we look at these trends over time, the patterns are pretty similar. Older ages tend to know more. Why? Well, they've they've learned, right? You learn a lot from the School of Hard Knocks, right? You get more confident, you can have more knowledge, you can intuitively start to figure out how things work. And so we see this gradient by age often, that older people are often the most financially savvy. They have the most financial knowledge about what they're doing. If the Federal Reserve in 2016 in their survey of consumer finances, they asked us sort of similar question. It wasn't how much do you know? It wasn't quizzes, questions. It was how much do you think you know? How confident are you in being able to say that you have high financial literacy? And the patterns are pretty similar. Out of a 1 to 10 scale, people in that older silent generation sort of give themselves something between 7.5 and 8. The boomers were around 7.5. The Gen X was between 7 and 7.5. Millennials actually gave themselves a fairly high rating, almost the same rating. Gen Z was lower, but still they gave themselves better than average, right? So 5 was average, they gave themselves 6.5. So this is a really important distinction. Do people really understand what they don't know and understand what they do know? And we worry a little bit about, especially millennials, thinking that they know more than they actually do when we ask them quiz questions. This overconfidence in their ability or their knowledge level is something we think a bit about. All right, so what do we think about? We think about financial literacy specifically. Some of this is just terms and definitions, right? When I said compound interest, you in your head started to think about what that means, right? You have the sense of like a bank account or a CD or whatever. I get the idea that my interest earns interest and that will grow over a long period of time, right? So things like that. Things like the rule of 72, which you may or may not know, but the sort of way to think about how many years will it take for something to double in value at a given interest rate. What happens when bond prices go up, and how do bond prices work? So that's a thing we can teach and people can understand. So there's lots of those kinds of things we can think about. Some of this is just applied numeracy too, thinking about percentage changes versus percentages, right? It turns out when they do surveys of numeracy, a lot of people get really baffled by the percent, right? The percents are really hard for the majority of people to get their heads around, especially if you're talking about percent change versus percentage rate, right? So these kinds of things can get people tripped up. Now take a look at the next time you get a statement from your financial companies that you might work with, or they actually use a lot of this kinds of terminology, and that trips people up, and so they just don't pay attention to it, tend to shut down. The other thing we think about with financial literacy is this sort of rules of thumb. Do you get, it's okay, you understand the terms, you can do a little bit of the math, but do you get sort of the rules of thumb? When somebody offers you something for nothing, do you think to yourself, there's got to be a catch in here somewhere, right? And that's a basic economic rule, right? We don't think that there's dollar bills on the sidewalk or else somebody would have already picked them up, right? So we tend to think about this idea of costs and benefits, of what the marginal value of the next thing is, those kinds of ideas. So, basic economic concepts, that the riskier something is, probably that's going to be priced into it in some way. So I might have more gains, but I could have more losses. And so thinking about how those kinds of rules of thumb work. And the last thing is knowing when to ask questions, right? So if you hear some of those things that don't seem to be consistent with what your definitions are, that don't seem to be consistent with what your sort of rules of thumb or your sort of basic economic thinking, you know enough to say, what do you say more about that? How does that work? So these are some of the key aspects of financial literacy that we think about. Unfortunately, when we try to measure financial literacy, we often default to those more definitional kinds of things. Do you understand that bond prices tend to move the opposite of interest rates? Those kinds of things, which maybe aren't the best kinds of measures. So we focus sometimes too much on the the rote knowledge and less on the application of the knowledge and how people actually behave in real life. So one question we get a lot is, well, a lot of things, I don't like to do a lot of things. I don't like to paint, so I hire a painter, right? I don't like to manage my money, so I'm going to hire a financial advisor, right? So that's a very common refrain we hear, and we actually hear this from our students sometimes. Like, why do I need to learn this? I'll just pay somebody to do this. It turns out the people who use financial advisors are some of the people with the highest levels of financial literacy. They're the ones who do best on these tests. And so it's more like financial literacy and financial advice. And we've looked at all different kinds of financial advice, everything from taxes to money management to all the way through. it tends to be a complement, not a substitute. People who have more financial literacy know to look for more help, and they go ask an advisor to help them with specific things. It's not that people who have low financial literacy then turn to an advisor because they just don't know what they're doing. It's just the opposite. People who have low financial literacy are less likely to go seek help, less likely to have somebody help them with their taxes, less likely to get a financial advice of any kind. And pretty much true across the generations. It's not just a baby boomer thing, right, or whatever. It's pretty common across different generations and over time. So yeah, we see people who do the best on their the purple line up there, the 65%. Those are people who got five out of. Actually, we did 6 questions in this one. 6 out of 6 questions correct, and about 2/3 of them use a financial advisor. Whereas at the bottom end, people who got none of the questions right, only about 1/3 or less than 1/3 use a financial advisor. So it's just pretty strong correlation between advice and knowledge. Anyway, my point is that there's no substitute for financial knowledge. You can't just hire it out. You can't just find some other source of it. All right, so let's just now assume that you agree with me that people at all ages need more financial literacy, need to have a sense of confidence in their financial decision making. The problem is that we don't know exactly how to teach that, right? So I just mentioned Wisconsin has passed a new mandate that that kids before they graduate from high school have to take a financial literacy class. It's a 1-semester class before they can graduate. That works. We see that in the credit data, that people who graduate from high school in a state that had one of these mandates in place, when they're in their early 20s, meaning 19, 20, 21, 22, 23, they have lower rates of being late on bills. They have lower rates of being in serious default or delinquency. They do better at managing their bills. They don't show any difference when they get to age 30 in terms of their savings rates. They don't show any difference in their use of student loans. They don't show any difference in other parts of their life. They're just less likely to make mistakes early in life. So we know that we can teach young people how not to make credit, especially credit mistakes early in life, but we still haven't figured out exactly how to teach people when they're young to think about things like a mortgage decision or retirement planning 20 years from now. So this isn't a one-size-fits-all thing. We know that when people are working in an employer that offers an employer-based plan, a defined contribution plan, where they have the option to put money into the plan, if we teach them about that plan and how it works and help them fill out that paperwork, they're more likely to enroll in that plan. We know that works in that setting, but I can't tell you that doing a lecture at the library is going to help anybody in that room manage their money better, right? So there's just not a lot of examples we can come up with of generic prescriptions that help people to manage their money better. We've done studies on things like financial coaching, where people work one-on-one with somebody. That can have a huge effect, but a good financial coach isn't going to serve more than a few hundred people, right? So can't get to scale with some of these kinds of things. So oftentimes we try to match it to the decision-making context that people are in, be it savings at work or paying off debt, counseling right as somebody is taking out a mortgage loan, those kinds of situations, or right before they retire, those kinds of situations. The other thing is that we've got to keep it simple. Too often we've seen financial education designed by educators, so I put myself in that bucket, and so I think it's all really interesting. So I think you should know not just about compound interest, but we're going to really get into let's think about some complex situations where the interest rate changes over time, and let's look at how risk might, it's just too much. We tend to make things overcomplicated. So it looks like that chart I showed you earlier of random equations. So keeping it really simple. The best financial education programs we've seen are really short, 15, 20 minutes on a particular topic and then some application. Right? It's not we used to do financial education for people taking out their first mortgage, to buy their first home. It was an 8-hour class, right? That's a lot, and that's way more than people needed. Now I think it's typically about an hour or so of an online curriculum that people go through and has about the same effect, which is positive, but an 8-hour class was overkill. So really thinking about making the information simple and useful. I think another thing is the flexibility and the convenience of how we deliver information. So classrooms are great if you have a situation where you can get people into a classroom, right? This is a beautiful facility. You're all here. You made the choice to be here. That's great. But if I try to do this back on campus with employees, say employees at physical plant who have just spent the morning shoveling sidewalks, this is going to be a tough environment, right? They're hungry. They got a million other things to do. I've got to try to find some better way to communicate information to them. Maybe it's on their cell phones. Maybe it's before work with a 15-minute, one-on-one. Maybe, who knows? Maybe it's on the phone when they're at home tonight, thinking about some of these kinds of things. So really being flexible in how we think about delivering information. It doesn't have to be all in one 8-hour spot. It could be, 15 minutes spread out over a week. So thinking about different ways to calibrate that. The other big mistake I think we often make with financial literacy is assuming that everyone's illiterate, right? We start from ground zero instead of building on people's strengths. Most people, especially low-income people who are financially vulnerable, they are really good at managing their money, right? They've had to get by knowing not only when a bill is due, but what time will that actually go to delinquency, right? I need to be able to know to time this because I know I get paid my employer, my paycheck deposits automatically at noon, but I know that my credit card bill, they won't check for that till 5, so I got 5 hours to get this done, right? So people are really good, and so you got to build on those strengths and not assume that people are somehow deficient. It's really sort of meeting people where they're at and helping build them up. So this is an example of something that UW Extension does, cooperative extension, which is now part of UW-Madison, if you've followed the news and all that. So we're working with them more and more. But this is a really simple tool that they use. It has 9 cubes, modules on different topics. So it starts with very simple things like, what are your financial goals? I'm not going to tell you what you should do, that you should save for retirement or that you should pay off your debt. You tell me what your goals are, and let's go through a process of setting up goals together. This is something they can do in 10 or 15 minutes, and people can determine. And so the whole room might have different goals. That's okay. We'll meet people where they're at. Maintaining an emergency fund. This turns out to be one of the most important factors in terms of whether people feel like they can handle a shock or not. It's, do I have even sometimes $400 in cash or a savings account that I could use if I had to get a car repair or I had some other kind of emergency come up. So this emergency fund, precautionary savings, rainy day fund, however you want to think about it, is really important. And so for a lot of people, it's just like, oh, yeah, that would help. Yeah, I could probably sweep $25 a month into this account that I'll sort of hold sacred just in case of emergency. And that's a simple thing that people can do. They just hadn't thought about setting that up before. Automating bills and spending. Most people don't worry too much about their bills because they get paid automatically. Same with savings, their retirement or what other savings might happen automatically. So automating as much as people are comfortable with, but knowing there's a limit. Some people don't like automatic payment. So there's an insurance company we worked with once, and they were testing products. They found that they worked really well, but they were really having a hard time, particularly African Americans in Milwaukee, taking up this product. And it turned out because the insurance company set up the date that the payments were due, it had to be automatically withdrawn, and it was always due like the end of the month. And so in that community, a lot of people were working for employers that were paying on the 1st, and they didn't like the idea of somebody automatically taking money out of their bank account on the 31st because they might be close to the bottom and not being it. So it turns out they liked the product. They didn't like the way the product was being paid for. Right, so we had to be careful about some of the assumptions we make on these kinds of products. Using a system to manage multiple accounts, it's great if you have everything in one credit union or one whatever, but people oftentimes have them spread all over the place, and it's easy to lose track. We have some researchers now at Wisconsin who are looking at abandoned accounts. So these are, imagine you work for 15 different employers over your career, and now you're in your 70s, and a couple of those employers set up an account, a 401k account for your retirement. It was a relatively low balance amount. You didn't really pay attention. You lost track of it. It actually goes to the state as an abandoned account. And the state, actually Wisconsin works pretty hard to try to find you. They go to the Department of Revenue to try to see if they can find you, if you're still in Wisconsin. But for a lot of states, these accounts just sit there, and so they become abandoned. And so people really have to think about how to manage their accounts, and consolidating accounts and just keeping things manageable. The paperwork itself becomes hard. Savings matches, as we talked about this with students a lot, making sure if your employer has a savings match, take advantage of it. Those little yard dollars on the sidewalk, you should pick them up and take advantage of those. Paying attention to due dates. We did an experiment with older people who were taking out reverse mortgages. So this is where instead of making a payment, you're actually getting money out of your house back to you. The trick there is that now you're on the hook to pay your property taxes. And so we sent them magnets so they could write the date that their property tax bills were due. We found a lower rate of people missing their property tax payments for that first payment. So really simple kind of thing, right? A magnet with a date on it can have an effect on behavior. Insurance, so often people neglect insurance, and I'm not here to sell insurance by any means, but a car accident, a property damage, those things can really dent people's savings. And so having insurance, health insurance is another example, is important, but also having the right insurance given where you're at. If you're a small business person or entrepreneur, having that protection could be really important. Paying off credit cards. A lot of people, I think the average now is like 4.5, 5 credit cards. It's not, the credit card strategy is for you to forget every once in a while, right? I mean, that's part of the deal. If you have more cards, there's more chance that one of them you'll forget about. So really trying to keep up on those. And then finally, watching fees. That's the biggest danger for most people's long-term, especially retirement accounts, is the fees will just, be drawing down what you could have. Now you're making money, and so you don't see it necessarily, but those fees can be really bleeding people's accounts. And so getting people, and same with banking, like banking fees, those kinds of fees, $25 a month for 10 years can really start to add up. So really trying to keep track of those fees and costs. Anyway, this is a really simple, I just taught you basically what UW Extension teaches in these classes in 5 minutes, a really simple example of what can be successful, getting it down to the most basic kinds of information. All right, let me give you a couple of hopeful studies. This is a study that we did in Wisconsin with employees who were working in, I think, about 80 different credit unions across the state. And they offered an online financial education to their employees with a focus on saving for retirement, right? Your employer has the ability for you to put money aside in a deferred contribution account for your retirement. You can add to that. And so the group that had the education increased their from about $250 to over $300 a month. The group that didn't get the education really didn't change the amount they contributed at all. So mostly these were people who were in retail, so I don't know what retail was making at that time, $20,000 to $30,000, mostly women. So they were the banker, they were the tellers at the credit unions by and large. So this is a significant amount of money. We figured over the next few years, they would have thousands more in their retirement savings. And because most of them were younger, that was going to result in tens of thousands of more of available funds for retirement. Pretty simple intervention online. They got work time to do it, but still it was a pretty simple kind of intervention. Yeah. Yeah. It is. I can get the website. I don't know it off the top of my head. It's FYI something, but I'll find that. Yeah, maybe I'll find it at the break. Yeah. Another study. So this is employees at state agencies. There were roughly 20 state agencies that were involved in this. So about half of them, 10 of them, there were committees of volunteers of women who looked at the rate of contributions among women at that agency and said, women are not contributing as much to their retirement accounts. So all these people have the employee trust funds, WRS, but they were not using the deferred compensation plans at the same rate as men, even controlling for income, education, age, all those kinds of things. So what did they do? They put some posters up, they sent some emails around, and they had a series of Wednesday lunchtime, I think they provided lunch, maybe it was bag lunch, but they had the forms so you could fill out, and targeted to women, the forms to come and fill out the form so you can contribute, $25 or a percentage, whatever. And so you can see the Empower agencies, Empower was the name of the program. It's actually, unfortunately, also the name of the retirement provider, but the Empower was the name of the program, not the provider, as an acronym. And so, yeah. This was 2016, 15, 16, I think. So it was in that range. And basically we see where that red line is where Empower came in. So basically women were trailing men before the program was put into place, and women started to catch up. So by the end, very simple intervention. It cost these agencies maybe some lunches, right? So very simple. And the main thing is helping people fill out these forms and just saying, women are going to live longer, you're trailing, you need to catch up. And they got a lot more engagement in that program. So, relatively modest program had some pretty big effects on people's retirement choice. All right, now I'm going to pivot a little bit to this idea of financial well-being. Financial well-being is a pretty new concept. I would say in the US, it really got steam in 2013, 14. It probably originated in the UK and the EU before that, this idea of financial well-being. But it's subjective. This is a subjective measure of how you think you're doing. And this all came about because there were these studies on life satisfaction, and they found that there were a lot of poor people who were very satisfied, and all rich people who were very unsatisfied. And so people started to unpack, researchers started to unpack what's going on. And so this concept of financial well-being was designed. So financial well-being, it's a scale. There's a 10-item scale and a 5-item scale, but they're still all measuring the same kinds of things. How financially independent do you feel? How much control do you feel like you have over your finances? How much stability do you think you have, do you feel like you have? And how much resilience do you have if something bad were to happen? So these are questions like, if you had an emergency, could you come up with the funds in so many days? If you had to give a gift for a wedding or a party, would that be a financial strain on you? Do you feel like you have confidence to find information when you need to make a financial decision? So those kinds of feeling type questions. Basically, do you feel like you can make choices that help you to be happy regardless of what your income, education, wealth levels are? And it's much more thinking about the person as opposed to the dollar amount. So we can look at these numbers now. We've been tracking them the last few years. And it's basically a 100-point scale where the average is around 50, so it's just calibrated to around 50-ish. And we can see that in the line up there, that red line at the very top, so it's not in your handouts, but you can see it on the screen, the top line, the circles, those are college degree holding men. After especially age 35, they feel financially well. They have the highest sense of financial well-being, and they really do show that increasing line all the way up into older ages. Just under them are college degree holding females, roughly 2-3 points below at almost every period. So when we first did this research, we said, oh, this is kind of bothersome. And then we talked to some people, and they're like, oh, women live longer. They're oftentimes the trailing spouse. There's some reasons they should feel a little less financially well. This might be totally normal. Men might feel more confident. They know they're not going to live as long. They know, think that they have other options. So maybe there's some story we can tell about this, but the numbers are what they are. No college degree holding. So these are people who have a high school degree up to 2 years of further education, but no 4-year degree. For men, lower, and then no college female below that. So we see that basic trend over different ages. But it's going up at all ages. So everybody's feeling more financially well as they get older. But definitely this gradient by education and by gender. So as we think about especially managing shocks and things like that, we have a book we did a few years ago, we called it Fragile Balance, that really looked at what helps people to feel more financially secure, financially capable. Definitely having goals matters, motivation, having a plan in place, having liquidity, emergency savings. Turns out that's a real key. If you know that you can come up with $400 in a pinch or $2,000 in a month, that helps you to feel more financially secure. And then finally, access to products and services, a safety net, and partly what we'll talk about with the next section. All right, let me think just a little bit, and then we'll go to the break, about this issue of retirement. And so I mentioned earlier that we think about retirement as a transition. So this is the share of people 2017, so 3 years ago now, by age who were still in the labor force. And so, goes down to about 8% at age 75 and older, so it's not everyone in their 70s is out of the labor force, but most are. And really somewhere in the early 60s to late 60s, the majority of people exit the labor force, so they're not earning as much in the labor market. And you can see by income, it's more likely that a lower income person is not in the labor force at older ages. It's more likely that a higher income person is in the labor force at an older age. Now, some of this is mechanical, right? If you're in the labor force, you're earning more. But these are pretty big numbers, right? These aren't just like driving Uber or bagging groceries. These are, pretty high income. So oftentimes one of the solutions that people put forward for low-income people in retirement is to work. And we see that not very often happening. A lot of that's because of health, disability, the inability to work, or not being able to be employed in jobs. Let's think a little other thing that's really changed is life expectancy. People are living longer. They have to prepare for a longer and longer retirement. Men continue to lag females, women. But in 1940, when we first implemented Social Security, only about half of men made it to age 65. Right? So think about how much different the context is today than it was when Social Security was first started. People are really having to think about living much longer and being able to manage their finances for a much longer period of time. I'm going to share a few more pieces of data and then we'll take a break. These are wealth levels for different ages. So the dotted lines are 2010, 2014. The grayish line is 2004 to 2008. And then the late 1990s, early 2000s is that solid line. And you can see that people tend to ramp up their savings, their wealth, peaking probably around age 70, although in the 2000s it was more like age 80, and then start to spend down in retirement. So probably a familiar pattern, right? It shouldn't be too similar, but the timing matters clearly. These are all adjusted for inflation, so you were lucky if you were in the late 90s, versus more recently if you hit the recession in 2010. Let's look at the bottom 20%, the bottom fifth of the wealth distribution. First of all, look at the axes here. Before we were looking at $400,000 or $500,000. Now we're looking at $40,000. So the bottom quarter of people have much lower levels of wealth, and it's variable. Same pattern, declining towards lower numbers as they age, but declining really towards zero, right? Particularly the cohort in 2010, they never got much above $10,000 in savings. And we're able to ride that a little bit and then declining from there. So we see very different patterns in wealth accumulation by different cohorts and also different groups across the country. And this is why that safety net in social insurance is such an important thing. So partly we have defined contribution plans, right? But if you look at the use of defined contribution plans at the lowest income levels, only about 1 in 3 people in the lowest income levels even have access to a defined contribution plan. At the highest, the higher levels, it's much more common. And defined benefit plans, like most of us have been lucky to be part of, are almost non-existent. So we just don't see them outside of public sector. And especially for lower income workers, we don't see them. So the old system and the old ways of savings are not as applicable for these lower income households. Housing wealth is the main way that people are saving, right? So you can imagine that people could be using their house as a way to, I reached 65, I sell my house, I use that cash to live on. What we find though is more and more people as they age, and I think this is my next slide, but what we find is more people are borrowing. So they reach 65 and they still have a mortgage. So they can't necessarily draw that equity out. I guess that's the difference here between the percent with savings and percent with a home saved out. The people that don't have their home paid off are the ones that have a mortgage, and so it's harder for them to tap that equity. But if you look at people at the low end of the distribution, home equity is their main way. Renters have almost no net worth. So older people, as they approach retirement, who have some housing wealth, that is for low-income people, that is their main source of wealth. Like I just said, there's like $10,000 in their other wealth. And home ownership is peaking, so a lot of people have homes, even at lower income levels, so that tends to be a common thing that we have. But we see more and more with mortgages. And so this is another risk for these lower income people, is that they have Very little liquid savings, and the savings they do have is tied up in their house, and a lot of that is leveraged. They have a mortgage against that. So all these are conditions, I think, as we think about the next generation of retirees, that make me a little worried about their well-being and what kinds of tools and resources are we going to have out there. One is a reverse mortgage. So you've probably seen commercials from, I don't know, any number of celebrities now are doing commercials for reverse mortgages. They're called HECMs. That's the product name that's actually insured by the federal government. Most people are using these for everyday expenses. You know, pay off a mortgage, everyday expenses, pay off non-mortgage debt, some for home improvements. So this is a way to convert their housing wealth into everyday consumption. Most people, if they take these out, I think our average age of people using these is around the early 70s. They've spent most of the money within 3-4 years, right? So it is a way to draw down some wealth, but then it's gone. And so it's not necessarily a long-term solution. By the way, when you have one of these, you now really can't, I mean, you can pass your house on to your heirs, but it's going to have this loan on it. So your heirs will have to pay this debt off before they could take the house. So there'll be enough equity there to sell the house and pay off the loan, but maybe not much left. Certainly not enough that your heirs could take the house. All right, so we'll break after this, but the best solution for people is to have enough money to cover their living expenses in retirement. They should have access to good savings programs, whether it's at work or through on their own. They should be able to work for most of their working years, right? So they may have to take breaks for child or other voluntary reasons, but they should be able to work. They shouldn't have disabilities or health problems that get in the way. They should approach retirement with a little debt, not much debt, not enough debt to be a burden. And they should have some coordination with their spouse and their family. And this is a pretty good scenario. And for a lot of people, this works pretty well. But for a chunk of people, it's not going to work so well as they approach retirement without any number of these things, with unstable work, without savings. All those things can sort of get in their way. So I'll stop after this, but this is my example I give. Somebody born in 1962, they started working in 1980 at age 18. They want to retire in 2027 at age 65. They earned $12,000 a year their first working year in 1980. They got 3% wage increases every year, so by the time last year, they made $25,000, pretty low income, just above poverty level. Not an unusual scenario, frankly. They save 3% of their income. That actually is kind of unusual, that most people don't save that much, and it grew at 5% annually. They'll have about $100,000 saved, $94,000 saved. If they claim Social Security, they'll get about $15,000. When they retire, they would be making about $30,000. So there's about a $15,000 gap per year between what they were making and what they want to live on in retirement. And so basically they would spend down their savings, and their savings would be spent by age 72. So this person could retire for 7 years, right? And then they would have exhausted. What do they do after age 72, right? How do they think about moving forward? So I will pause with that. We'll take a break, and then we'll pick up thinking about Social Security.
Let's get started again. Michael, I'll just let him continue.
All right, sounds good.
And at the end, we will have a chance for questions, detailed questions.
Great. All right, so as I said, we're going to shift now towards some more of these policy issues. And so I'm starting with this example of, typical kind of working person, maybe with high school education, very typical earnings trajectory, for whom things go well, right? They're able to work all those years, able to save some of that period of time. I don't know if you'd say best case scenario, but a good case scenario only has about 7 years worth of savings. If we look at the data of people in retirement, so people in 65 to 74-year-olds, Social Security is 57% of their income. The other things they have are some work. They'll continue to work, maybe part-time, maybe minimum wage, maybe have some other pensions, although this is really shifting, as I showed you in those graphs earlier. Most low-income people today are not at work, or they're not working for employers like they were maybe in the 50s or 60s that had any kind of defined benefit plan. And public assistance, right? That is sort of what we're left with for people who worked most of their career and were able to save up a little bit. Those with some retirement savings, it turns out those with some retirement savings are actually more likely to work because people, they tend to have higher education. They tend to be in jobs where maybe they could work as a consultant or have other kinds of earnings. So less dependent on Social Security and a little more likely to have a defined contribution plan. So they have some plan that was available through work. If there were no Social Security, we'd have 15 million more seniors in poverty, meaning below the poverty line. So it is a really major social safety net program. We refer to Social Security as social insurance, and it really is designed to protect people in older ages from poverty. It's also an insurance against outliving your savings because you can continue to draw Social Security. If you live to be 110, you can continue to get Social Security until you're 110, and it'll be adjusted for inflation. It's like an annuity. And so it really is an insurance against outliving your savings, whatever savings you might have. So it's a really critical social insurance program, and I thought this even before we were funded by the Social Security Administration. It is a really, really important program. So, you probably know some of these statistics, but about 50 million people get the old age and survivors plan. So that's you can claim that at 62 or 65 or 66 or whatever age. And then about 10 million who are in the disability programs. Now, if you followed the news, there was a sort of ramp up in people claiming disability during the Great Recession, and now a dramatic drop in the number of people getting disability. That's one of the research topics that we're trying to understand better, is what explains the lack of people going on to disability today. Certainly the job market is very, very strong. It appears that employers are willing to make a lot more accommodations than they did in the past to help people to be able to work even if they have a relatively modest physical or cognitive disability. But it's still a major program, 10 million people who are claiming disability. And so this is everything from physical disability, cognitive disability, people who have worked for some, so in order to get on the the disability program, the SSDI, Social Security Disability Program, you had to have had some work. You had to have paid into FICA to payroll taxes to be eligible. So people worked for some period of time and then claimed disability. So that's about 10 million people. Again, it's an important part of the social safety net. We study both retirement and disability in conjunction because they tend to run together. One of the reasons you can't work is because you have a disability. And so that makes that retirement choice less of a choice and more of a, I just can't work, right? So it's thinking about those things that disrupt earnings. And there's about 5 million people in the SSI program, the Supplemental Security Income. So oftentimes people think about SSI as for people who have physical or cognitive disabilities as youth and sort of, are never able to work. And so that's true. A lot of kids are covered under SSI. As kids transition at age 18, maybe they have some disabilities that allow them to work partly, and so maybe they wouldn't be on SSI, but some do, and they continue to be on SSI for most of their life. SSI is also used for people age 65 and older who are low income. So it is essentially a poverty safety net for very low income seniors. And so, again, another important program. And then as we think about all these Social Security programs, disability, retirement, old age insurance, we have to think about health care, right? So the important component of Social Security is access to Medicare. The important access, same with Social Security disability, SSDI, you can get on Medicare after 2 years of being disabled. So there's a strong connection or complementarity to health care and the inability to work. Partly it's as you get older, you have more healthcare needs, right? So we know some of that. Partly as people with disabilities have more healthcare needs. But the main way we deliver healthcare services is through employers. And so these groups I'm talking about now are not employed, so they don't have any other access to, unless they were to get it privately, which doesn't very often, they don't have any other access other than Medicare. Medicaid is obviously the low-income program, and so some people are dually, and especially in older ages, if they're very low-income, they might be dually eligible for Social Security, SSI, Medicare, and Medicaid. So they might have all these programs at very, very low-income levels. So a lot of interconnections between these programs, and so we spend a lot of time thinking about how they connect. They don't all come in at once. Oftentimes you're on one and part on the other, and so we have lots of discontinuities in how people access these programs. But this safety net is big, and I don't know if you probably all appreciate this, but I think in the general public, a lot of people don't understand quite the importance of Social Security and the related programs for, especially for sort of the most vulnerable populations in society. So, I mean, you know this, I'm sure, but, we have seen a change in the age at which you can claim full retirement. The terminology is awful. Even Social Security says it's awful. Full retirement, which isn't the most you can get, but anyway. You can claim early at 62, or claim at your full age, or claim later and get more up until age in the 70s. But that's changed over time. So current cohorts today are looking at age 66-ish for claiming full retirement. And for later cohorts, it's going to go up to 67. So we are actually moving our age forward a little bit of what that full retirement age. This is happening all across the world. If you follow the news, what's happening in France, they're trying to standardize how some of their programs work. Brazil, lots of countries are dealing. Sweden, lots of countries are trying to figure out how to get these ages up a little bit older, since like I said earlier, when Social Security started in 1940, most men, or the majority of men, were making it to 65, right? So we're getting a much older age distribution now. So SSI, so there's about 2.2 million seniors. So these are older people, 65 and older, who are on SSI, and it's because they're poor. They have low income. So the benefit on SSI is $750 a month. Or $1,250 for a couple. So we're not talking about a large amount of money, but it's enough to help people to just stay afloat. The other thing about SSI is you can have basically no assets, right? So they exclude a few different kinds of housing and automobiles, things like that, but generally you can't have a lot of cash, you can't have a lot of savings for retirement, those kinds of things. So these are low-income families, $13,000 for a couple, almost $14,000 for a couple. But that's really a part of that safety net for these, as families age, what they're able to see. And we still have, I think the current data on older people applying is pretty flat. So we've had, in 2009, we had about 60,000 applications. In 2017, we had about 60,000 to 70,000 applications. So this is sort of a steady state program that a lot of people are needing. Older people, the younger older people, whatever you want to call it, people 65 to 69, what we're seeing is a lot of those low-income people, instead of going on SSI, are just working longer, right? They're working more, staying in the labor force, and that's partly because the labor market will hire them. Right now, employers will hire a lot of people that they wouldn't have hired 10 years ago. So we've seen a shift in that way. All right, so if we look at just the earnings distribution of people 65 and older, where do people in their 60s, 70s, 80s, and older receive their money? And we can just look at the income level. So the very top row there are the lowest income, the lowest 10% of the distribution, and the highest is the top 10% of the distribution. For that lowest group, they're not working. 3% have earnings. And actually, we don't see earnings start to really be a player until the top 20% of the income distribution. Older people who have skills can work. So people with PhDs or college degrees or specialized skills, they can continue to work. And they might be able to work even if they have physical limitations, right? Because they tend to do kinds of work that you don't have to be physically nimble to do. You could do it sitting in a chair. You could do it on a computer. You could do it remotely. So it gives them more ability to work. At the lowest income levels, there's not a lot of earnings. They don't have the ability to work. Why? Well, I mean, maybe they worked in manual labor for 50 years and they don't have the physical ability to do that. Maybe there's not a lot of demand for the kind of work they can do. Maybe they, worked in a factory or something like that, and there's just not a lot of demand for those kinds of skilled positions. And maybe they're just not able to keep up anymore. And so there just isn't a lot of use for labor, which is unfortunate, but there's just working is not an option. And so oftentimes you'll hear sort of policy debates, well, older people can go back to work. I see people at the grocery store bagging groceries, right? It seems to be possible. It is possible for those who are physically able to and for whom they can find an employer who will hire them, but it isn't necessarily true at the very lowest end. So for this group, the old age insurance at the very lowest is actually not as common as this a couple of rungs up. the income distribution. We're still talking about pretty low-income people, though. But it's, for that second tier, the second to poorest of the income distribution, 80% of their income is coming from old age insurance, from OASI, the program that they claim at mostly age 62. SSI is more important at the lowest income level, so because they're poor. Retirement plan, there's just very little of it, 6%, right? So very, very little. At the top end of the distribution, it's 40% or more retirement plan. Other, which is just a bunch of other stuff. But then you can see the Social Security amount. So the amount that people are getting in Social Security is around $12,000, $13,000 at the lowest income levels, up to $25,000 at the highest income levels. So we've gone much higher in income level, but our Social Security amount really hasn't gone up that much. It has this, it's designed intentionally to cross-subsidize the lowest income group so that it can still, that group of people can still get by and still have enough. Now, I don't know if you can say $13,000 is getting by, but it's enough to sort of keep them out of poverty, especially for a couple combined with other programs. If we look at the distribution over time, so this is a little bit fuzzy on mine, hopefully it shows up there better. The Social Security sources of income in 1962, which I think we can mostly agree is a while back, was about 31%, and now it's 33%. So it hasn't shifted much over time. We haven't seen a big change. We've seen more earnings. There's more people working today. It makes sense. Compared to the 60s, we have a much healthier, older cohort. Asset income, much lower, much less living off assets. Pensions, now for the people who were in 2015, they lived in an era when pensions were more common. Now we're sort of swung the other way. So if we, fast forward 20 years, we won't see pensions probably playing the same role as they did in the 2015. So we've definitely seen some shift over time, but Social Security has been that bedrock really across all these different years. So you've read the news, you know what's going on. There's a real concern about Social Security going bankrupt. The Governor's Commission Governor's Task Force had a hearing in Milwaukee a couple weeks ago, and we probably had, 20 or 30 different people come up and talk about their story as either person preparing for retirement or in retirement, and half of them said, well, Social Security's going bankrupt. Right? Social Security's going bankrupt, including people who worked for Congress people, right? So who are employees in the federal system. So there's this real sense of Social Security going bankrupt. So what do people say what do they mean when they say that? We're going to have fewer workers per person drawing benefits. That's what we mean. Back in 1955, we had 8 or 9 workers per beneficiary. Today, we're at about 3 workers per beneficiary. We're going to go down to about 2 workers per beneficiary. So that means each worker has to pay a lot more into the system to support a larger and larger number of beneficiaries. Why? Well, our birth rate is not what it used to be. Right? Families are smaller. People are not having as many kids. We don't have as many workers per beneficiary. The baby boom was big. It was a big group, and that's part of this. Immigration, whatever you feel about immigration from a political standpoint, it lowers the number of workers that are paying into the system. And so by having fewer people come in, fewer people paying into the system, fewer babies born, you're going to have fewer workers. And then there's health mortality too. We not only have more beneficiaries, but they're living longer. Right? So today's older people aren't drawing Social Security for 10 years. They're staying in the system for 20 years. And so that means more demand for those services. So all those things are driving this narrative that Social Security is going bankrupt. It's demography, largely, that's driving this. All right, so let me go back to our example of the person born in 1962. What are they going to do? I just told you they're going to run out of money at age 72, right? They're going to have 7 years worth of savings, and they did pretty good. So one is they could use their housing. I just told you a lot of people, especially lower income people, have housing. They could sell the house and live off that. They could move out and rent it and get income from it. They could borrow against it, right? Those are all different ways they can get money out of the house. If they have the owner, then if they are the owner, then they could do that. Sometimes we see people too say, well, if I just pay off my mortgage, then I don't have to pay that mortgage anymore, and that gives me some more money coming in too. We often see people stop maintaining their house at all. That's a way to save money, is not put any money into it. Now, if you've ever been the owner of a house that was owned by an older person who let it go, there's a cost to that, but that's another strategy. They could delay drawing Social Security. They could wait till age 70. They would get more per month for the rest of their life. Now they would get $21,000. They would have also, by drawing later, they would have saved longer. They would have worked for 5 more years, paid in to their savings. They would have over $125,000 saved if they would continue to save over that period of time. Now they could live to age 81, right, by making some different decisions. Still, a male who makes it to age 70 is likely to live to age 85, so there'd still be a shortfall, but not as much, right? I mean, this would be a better situation. And they could continue to work part-time, try to cut expenses. They could rely on spousal support or family support. You probably know these strategies. But the big wild card here is at age 65, can they work? Will they find work? Can they still physically work? Can they mentally work? So the ability to work is a really important part of the retirement equation for low-income households. And I just showed you the data at the very lowest level, they're not very likely to work. Either employers aren't interested in their labor or they just don't have the physical ability. And that ability to work really becomes the crux of the issue for a lot of low-income families. Now, before I move on, I want to say that Social Security is not going bankrupt. The worst case scenario, and let's hope policymakers don't let this happen, is that they'll pay 80 cents on the dollar. And that'll happen sometime 2040-ish, right? So the actuaries come out with a new set of tables every year. Disability was going to go bankrupt in like 4 years, a few years ago, and now they're pushing it out to 2050. So the actuaries' assumptions vary widely, and so things can change. But it will not be a case where you get nothing. It's a case where you get less than you thought you were going to get, right? And so I try to dispel that myth with young people all the time, because this program's really important, and I want people to know that it's important and not say like, oh, who cares? I never thought that was important anyway. I don't care if they get rid of it, right? We do think it's important. But it's really important for low-income people. Without Social Security, we would have a lot more poverty among low-income households, already low-income households, but they would be abjectly poor. Housing wealth is important, and I think we do have to think hard about housing wealth. There is a growing number of people in their 70s who have 30-year mortgages. Should they? I don't know. Maybe hundreds of reasonable expectation, right? Maybe they're not planning on carrying that loan for 30 years. Maybe they're going to pay that off. But banks are not allowed to discriminate on age or race or other factors. So, if somebody can support the income that's required for a 30-year mortgage at age 70, a bank will make that loan. That's not an issue. I think the question is whether it's good for people and their financial stability. It is certainly stressful, and we know that financial well-being is affected by things like these regular payments. Something I haven't talked much about, but healthcare costs. This is another big wild card. How much out-of-pocket cost are people going to face? We've done lots of studies where it turns out that healthcare interactions with finances are one of the major shocks that throws people off from their ability to feel financially secure and from retirement. Out-of-pocket, and I'm not talking about people who don't have insurance, right? People who don't have insurance are obviously going to have huge financial constraints. I'm talking about people who have insurance and they have an increasing deductible amount, so a high deductible plan, or maybe a regular deductible plan, but the deductibles are high, right? So they don't get any of the benefits of a high deductible plan, like a health savings account, but they still have to pay a lot of out-of-pocket. And then there's surprise costs, there's the things like the ambulance or the medevac helicopter, all those kinds of things that people pay for. Lots of these issues really matter. This is across the income spectrum and really across the age spectrum. Even within Medicare, there's so many different variations in Medicare, Medigap, Medicare Advantage, all these plans. It's not hard to get in a position where suddenly you have a prescription or a treatment or something that's not covered, and now it comes out of your pocket. It is a pretty big threat to people's ability to consume at the same levels in retirement, or to be able to save for retirement if they're still in working age. Obviously, anything we can do to help people reduce their consumption costs in retirement is a good thing, right? So reducing housing costs, reducing energy costs, reducing transportation costs, food costs, all these, reductions in cost are good, including benefit programs. Things like SNAP, so the formerly called food stamps, food share in Wisconsin. Those are important programs. Or LIHEAP, which is heating assistance for low-income people in Wisconsin. So at very low incomes, these programs are really, really important. Now let's talk about long-term care, which is, I know, not an uplifting topic, but about half of people in their 60s are at some point going to need long-term care for some point in time. Long-term care is really expensive, right? I mean, depending upon the level of care, it would wipe out most people's savings pretty quickly. There is insurance for long-term care. It's not a great market, right? I mean, there's plans that exist that don't cover people very well. We've heard lots of bad press about how these plans have paid out. But then we also have the cost of caring for somebody else. So maybe you're not somebody who needs long-term care, but your spouse, family member, sibling, somebody else does, or child. And that then draws on your resources, your time, your resources. Maybe you're physically caring for somebody, maybe you're paying for somebody else to care for somebody, so it's drawing down your assets. Plus now they can't work. They can't save for their own retirement or pay their own bills, those kinds of things. So, there's lots of these issues that come up. The longer we live, the more we have these multi-generational households and interdependencies, the more complicated these issues get. So this is some data from the Kaiser Family Foundation that's been tracking this pretty closely. And this is not including people who are in Medicare Advantage, right? So these are, people who are in other kinds of coverage. And about 26% of that lowest income group, of the lowest income group, they're spending about 26%, about $1 in every $4 that they have on healthcare, right? So healthcare is eating a larger and larger share of people's budgets. Now, even at the higher income levels, it's still 7%. So a relatively large chunk, and in between as well. So Medicare, remember Medicare is a relatively new program. In 1965, it came into place. It's expanded over time. Part D was the last big expansion. So this is back from it started to now. So healthcare costs are now 3% of GDP and heading up from there. So we're seeing, when it first started, healthcare costs were 0.5% of GDP. So we're seeing healthcare costs increase over time, and Medicare reflects that. Should healthcare costs be going up like that? I think that's a different policy question. Healthcare is really good, right? So hopefully it's reflecting somewhat that we can get care that we couldn't get in the 1960s, but it is a growing cost. In addition to the stresses on Social Security, we have the stresses on the Medicare program. So we're going to see these programs grow over time. Medicaid up to $1 trillion, Medicare $1.5 trillion, and then we have our private health insurance. All these plans are growing in their costs. So it's not like Medicare or Medicaid, you hear this policy debate, they're wasting money, they're spending, no, it's like all healthcare costs are going up. And this, granted, we have a very unusual healthcare system in the United States relative to other countries, but most countries are seeing an increase in healthcare costs. Now, we spend more per person, per treatment, those kinds of things. We may not be the most efficient, but the general trend across the board is we're spending more as a world on healthcare. If you look at the average monthly benefit of somebody getting Social Security, it's up to, again, 26%, 25%. $1 in every $4 that people are getting from Social Security is going to pay for healthcare. This is just Part D, Part B, and Part D premiums. Not even out-of-pocket stuff. So, the cost of care, the cost of insurance, the cost of out-of-pocket, all these things are rising. And they're most acutely felt at the sort of lower income of the spectrum. So Medicare, yes, we have a trust fund for that too. We have a trust fund for all these different programs. That's the program that actually is looking the bleakest in terms of its actuarial tables. They're saying 2026 to be depleted. I think that's gone up a little bit, maybe 2027. So well before Social Security. I've yet to hear any of my undergrads say anything about Social Security is going bankrupt, but not Medicare. Like, they don't even pay any attention to the fact that Medicare is. And part of it is because we're going to fill that with appropriations. We've made a commitment that that's how we're going to fund it. So Medicare is going to just grow to, be 6% of GDP by 2040. So a rising chunk of the public resources are going to be drawn into that system. All right, so how do we think about policy choices going forward? I think the most important thing to think about with Social Security is that it's very much needed, that the situation we're in is because of demographics. It's not because the fund has been poorly managed. It's not because we've made poor policy choices, although we're approaching that point. We just have a smaller base to be paying into. Now, Medicare is tough. That's part of a larger healthcare system. Medicare can't just suddenly start paying less because the rest of the healthcare system is paying more. So there's no easy answer here. And so oftentimes what we get policymakers saying is, well, next year. Right? We'll just keep worrying about that later. And we do have options in Medicare, so I think we're going to see more out-of-pocket cost. Whenever I talk to financial planning classes or groups, you got to save for out-of-pocket costs. I don't care if you're 30, 40, 50, 60, 70, you're going to have more out-of-pocket costs. And you're going to have to make decisions about what care to get and how much of that you're going to pay out of your own pocket. It's just going to be the way it is. We're going to see Medicare premiums rise. It's just hard to see that not happening. We're probably going to start to change the eligibility age. I didn't say whether it's going to go up or down, right? We might want it to go down because then we get more healthy people paying in. But we're probably going to have to see some change in the Medicare eligibility age. We're probably going to see more cost controls. Things like these accountable care organizations or Medicare Advantage, where we just are becoming more rigid about what we pay and who we pay and who's eligible. And we're probably eventually looking at an increase in the payroll tax. That's the solution that's going to have to be on the table at some point. That would solve the problem, but the question is how much of payroll are workers willing to give up to make that, and employers willing to make that happen. For the old age program, for the retirement benefit program, it's actually a much easier solution. I think where it gets complicated is that you can't do one thing in isolation. You can't fix Medicare without fixing Social Security. You can't fix disability without fixing old age. They all sort of have to be dealt with together, and that's usually not how we approach these policy issues, unfortunately. But increasing the retirement age, 67 is a fine place to be now, but we know that people are living longer and longer, so 67 is not going to cut it for the next generation. Millennials probably should be at 68, so we should be thinking about indexing that age of retirement to what the actual longevity of the population is. That would solve 40% of the gap, just doing that alone. We could slow the benefit for people at the highest income distribution. So the cost of living adjustments right now, which have actually gotten a lot of political play in the campaign lately, you could do those for some but not all, right? And if you adjusted those back, that would close the gap a little bit. You could expand who pays into the payroll tax. You could change how the benefits are calculated. So there's different things we could do to these programs that would be relatively subtle and would be much less drastic than an 80% drop or a 20% or 20-point drop in the benefits paid. We could also put more workers into the system. Right now there's state and local workers that don't, they do in Wisconsin, but in other states that don't pay into the system. There's ways we could fix Social Security. Politically, these seem like pretty feasible things, but that's not how our political system works. Other thing that I think we have to think a little bit about is that Social Security and these other programs are seen as a program for the aged, right? It's for old people. And Medicare's for old people, and Medicaid's for the poor people, and disabilities for the disabled people. And it's really affects all of us, right? So my decisions that I make in my 30s about retirement are going to be affected by what changes with the old age plan. Likewise, I'm going to be making choices about how much I need to have to take care of my parents, or my parents are going to be making choices about how they need to take care of me. And so all these things are connected. And so, we just have to recognize that people are living longer. We have more, as I said earlier, we have more intergenerational connections than we did before, because we just have 3 or 4 generations still alive and living with each other and working with each other. Women particularly are likely to outlive men. So that's going to create I mean, it does create already issues in terms of who's the financial decision maker and what supports are exchanged across generations between mothers and daughters or sons. You know, and I think we're seeing a rising number of people 65 and older who are living with two other generations. So maybe a grandchild and a child, or maybe their own parents who's still alive. So, you know, we're seeing more and more of these interactions of people across generations. I think this is, from a policy perspective, good, right? Because maybe it starts to think like we're all in the same boat, it's not us versus them, but that's a really hard bridge to make when you hear the political debate right now. A few more financial planning issues we should think about. So estates are something we often don't pay a lot of attention to, and I think it's becoming a bigger issue as the baby boomer ages, and we're realizing there's more and more stuff that has to be taken care of. So it's not like in my parents' generation where maybe there was a pension and a house and that was it was easy. Now we've got deferred contribution accounts and health savings accounts and all kinds of different things. So just making people more aware of things like titling and beneficiaries and updating documents and where are the documents and, you know, those kinds of things. Same with life insurance. You know, I have a life insurance policy my parents took out of me a long time ago that I frequently forget about, right? So like, well, how will I keep track of that? And just document management. Also using life insurance appropriately, which oftentimes people in their 30s and 40s should have probably some term insurance because there is some risk to them and they don't. And so thinking about those kinds of things. Debt now debt used to be a young person's game. Now debt is every person's game. We see older people with credit cards. We see older people with student loans. We see, you know, all these kinds of things interacting. Taxes are changing, right? We just saw some changes in tax laws that affect the required minimum distributions from retirement accounts. We're seeing different kinds of changes to different accounts. It seems like they're tweaking programs all the time. Lots of discussion now about that. So, you know, these are issues we got to pay attention to. And this abandoned accounts issue, which has become something I've been thinking a lot more since we've done some research in this space. There's a lot of accounts out there that are small and that people lose track of. And is this really the way we want to manage people's, you know, retirement security, is with these accumulating little accounts here and there? We've got to make it easier for people to manage accounts, consolidated accounts, rollover accounts. You know, I understand that we want to be careful about the tax system and the tax advantages, but we got to think about these kind of things. Another depressing topic is cognitive decline. You know, about 1 in 5 people by age 80 will show some signs of cognitive decline. So these are questions just like, what's the year or the season, or, you know, where are we right now? What state, what county? So people who have some, you know, lack of orientation, you know, still not, it's not the majority by any means, but, you know, for a couple, you each have a risk of, you know, 1 in 5 at age 80 of having some of these declines. Who's managing the finances? In a world where you just had a pension that was coming to you, that was fine, right? The check still came regardless of whether you knew it was, I mean, maybe you spend it in erratic ways, but, you know, at least you had it coming in. But in a world where you're actually managing your money, you have a defined contribution plan and you're trying to figure out how much to draw and how to not pay a penalty for the required minimum distribution, and you're starting to not be oriented, that's a real issue. So we've seen a real rise in financial fraud, especially targeted at seniors. We've seen it everywhere from bank accounts to credit unions, all the way through Social Security. Social Security Administration is seeing more and more people targeting. When people search for Social Security, they'll come up with fraudulent, you know, but your search engine will bring you to fraudulent places, right? So the fraudsters are trying to take advantage of people who are vulnerable. Some other hot issues that we're thinking about, you know, particularly these, as I mentioned earlier, how we think about the complementarity of defined contribution accounts in old age and how people manage those. The whole issue of Medicare cost sharing, the growth of health savings accounts, which maybe you all kind of missed that growth, but a lot of people who are my age and a little bit older are now having these accounts, and how we manage those. They're like a retirement account in some ways, but require some different uses. Annuitization. So the Secure Act last December that was passed included this provision that people, as they approach retirement, should have the ability to get an annuity, a low-cost annuity as part of their retirement plan. That's a new thing. We haven't really seen a vibrant annuity market. WRS is a great annuity. It's the cheapest annuity you can imagine, but most people don't have those at their workplace. We're seeing a real growth in Medicare Advantage, the supplemental plans, how we manage all that. And then I think we've got a lot of issues just around the chronic conditions and end of life, and we can we can see a lot of people spending a lot on healthcare and support for a long period of time. You know, the actuaries at Social Security have made this point several times that people in the 70s and 80s who were frail didn't get to Social Security, right? We had, you know, the weakest didn't survive, right, to get into the plan. Today, we have a much healthier cohort. People who wouldn't have lived long enough to claim Social Security are living long enough to claim Social Security, getting into Medicare, and now they're getting different kinds of diseases. They're not dying, you know, dropping dead of a heart attack. They're getting dementia and living 5, 6, 7 years. They're getting long-term debilitative diseases. That's a real shift. So we're seeing a shift not only in who's in the population, but who's living to longer ages and the kinds of diseases and ailments they get. And that's sort of changing how we think about end of life and thinking about these interdependencies that we have across generations and certainly healthcare costs at the same time. All right, so I will just close by saying a quick commercial, which is not really a commercial, but so Social Security Administration has funded us to be part of this retirement and disability coalition. So it's 4 universities. It's Boston College, Michigan, the National Bureau of Economic Research in Wisconsin that are researching issues related to retirement and disability because, again, they're enmeshed, right? So healthcare, Medicare, Medicaid, they all come together. So we have, in any given year, between 15 and 20 studies that are going on, mostly focused on vulnerable populations, not high net worth populations, but vulnerable populations. We also are engaging in training, so we're trying to train junior scholars, especially scholars of color, to come into this field to study issues of disability and retirement. Doing a lot of translational work, which is just sort of getting underway, but you know, how do we translate it for practitioners, for counselors, for people who are in the field? And again, this real focus on economically vulnerable populations. That said, I'll use my disclaimer again. These are my thoughts, and not the thoughts of Social Security Administration, University of Wisconsin, or any of our other funders. And I'm happy to take your questions. So, yeah. I'll just repeat it.
The question?
Yeah, I'll repeat it. So the question is, how often do legislators seek our advice in terms of formulating policies? We have a great partnership with employee trust funds. So many of you know employee trust funds well. We'll do data work with them. We'll help them, like the study I showed you of the gap between men and women we worked on with them. So they've been a really great partner and worked a lot with us at the state level. Now that's very specific to public employees. Generally, the issues that with retirement tend to be pushed onto employers. And so we don't often get employers asking about these kinds of things. We have worked a little bit with financial advisors and with the companies that manage plans. So they're the record keepers for plans and thinking about some of those kinds of issues. I'll just say for most of them, they don't have a lot of ability to do very much because they tend to be very high volume programs that are run through an employer, and it's really hard to get a lot of traction there. At the federal level, we work with Social Security Administration, but of course, they don't set the policies. They administer the policies that are put into place at the legislature, and we really haven't had a lot of back and forth with federal legislators.
If you have a question, please raise your hand, and I'll try to get to you.
Just a question. So there's a lot of talk about Medicare for all now on the campaign trail. Can you just comment on, is it possible? Could we do something like that, or is it just words that people are offering?
There are some definite advantages of having a Medicare risk pool that has more healthy people in it. And so one of the advantages of a program like Medicare for All, and whether it's truly for all or just lowering the age of Medicare eligibility, so more people pay in premiums, more people who don't take as much out of the system because they're healthier, that could be an advantage. I think there's a lot of thorny issues, so most of the Medicare for All plans I've seen are not very detailed. So we don't exactly know how it would work. Some of the stuff I've seen says no out-of-pocket costs, and that to me seems like fantasy. Like I just don't think we're gonna have increasing premiums, we're gonna have increasing out-of-costs. So I think some of those things politically may be feasible, or maybe feasible, but financially it's really hard to think about how that would be feasible. So I think there are some interesting components to this as well. The biggest problem that we have with healthcare isn't necessarily Medicare. It's that we provide it through employers, And the employer's provision of healthcare is really varied. And then if you don't happen to be an employer that has good coverage, then maybe you get it on your own, but it's really kind of hit or miss. And so one of the advantages of a Medicare for all is we get the employers out of the equation. That would be a rough transition. And so a lot of people politically don't want to let go of the coverage they have. So it's hard to know how much feasibility it has politically, but I think financially it would have to have some cost sharing provisions in it. So the question was about abandoned or lost account. So you can certainly, each state has a unit that's responsible for managing lost accounts. So Wisconsin has one, other states do too. So that would be the easiest place to start. And certainly you can think about the states where you would have lived and might have an account that would have your name on it. You can do those searches there. There are firms that do this. I think there's some reasons to feel suspicious about some of these firms. Some of them seem legit, some of them don't. What we found is a lot of these accounts tend to have relatively small balances. So my mother passed away, and I have 4 sisters, so there's 5 of us. We found an account for like $120, so we would each get, $20? We all had to sign a, what do you call it, we're the notary. We had to sign notary papers, and we all live in different cities. And we're like, eh. So some of them are small, but some of them aren't. Some, I think $5,000 to $10,000, and some are larger than that. So Wisconsin is good in terms of they actually try to scrape the records that they have. DOR, the Department of Revenue, from tax records to try to find you and affirmatively go out and find people. So we have one of the lower rates of abandoned accounts, but other states are not as proactive. And so it's up to you as the account owner to contract these things down. So the question is just about how we cover long-term care costs and whether Medicare could cover those. So right now, a lot of people end up using Medicaid as their long-term care coverage, right? So basically they deplete their assets and they have low incomes, and they're eligible to use Medicaid. And the long-term care provision from Medicaid is a huge chunk of why Medicaid costs are rising, right? So more and more people are using Medicaid to cover these kinds of costs. So a rational response would be like, well, let's right-size it. Let's make this right and actually cover this stuff under Medicare. It's just expensive, and so that's part of it. And the private market attempts to try to serve this, the private long-term care insurance that have come up have way underpriced what the premiums are. And so then when people have it, they feel like, well, I deserve it. I need to go use it. And so they end up I don't say overusing, but they claim it faster than they probably would have otherwise. So we'd have to really think hard about how we design it to avoid that problem of people using care until they really need it. The other thing that's come up, especially in Medicaid, is more in-home care and trying to find lower cost solutions to long-term care so that people can, because people generally want to stay in their house, and try to come up with ways to have more skilled people who can come in and help people so they don't have to be in a full-time facility, which is where the cost is. So I think it is possible. It would be expensive, and I think trying to figure out how to manage those expenses would be the thorny part of it.
Just a comment. I recently read that a study has just appeared in The Lancet, which is a medical-related journal, about significant reduction of costs through a Medicare for All plan. So I think there's going to be a lot more information coming out within the next few months about what a Medicare for All plan could really do for everybody.
Yep.
So keep an eye out for that.
Yeah, I think, the devil's in the details, so we need more details to evaluate some of these plans for sure. And likewise, Wisconsin has not participated in some of the availability of health care that other states have, and there have been studies that show actually Wisconsin saves money if we start to move to expanded coverage. So, I think we've got to sort of figure out the details and try to really do the math on some of these to make those cases to policymakers.
There have been the recent federal policy proposals to cut Medicare, Medicaid. I haven't seen any details related to that. Could you comment on some of those details and what the likelihood of passage would be?
Yeah.
That's the tricky part.
Yeah, I'll defer the second to my political science colleagues about how likely these things are to pass. I think Medicare seems to me politically pretty safe because it has a really strong constituency. Programs like Medicaid are seen as poor people programs. Those are for the other people, and I do worry about some of those. Mainly what we've seen on the Medicaid side is the idea of state basically block grants to states and letting states have more and more control. So some states might be generous and some states might not be generous, and we'd see how that plays out. I can't see any feasible cuts to these programs in terms of what people get in coverage, right? So if we have people who are poor and need care and they don't get covered, are they not going to get care? No, they're going to end up going to the emergency room. And then they're not going to be able to pay for that care, and so the hospitals or whatever providers are going to basically write that off as charity care, and then guess what? All of our healthcare costs we're all going to pay for it. So we're going to pay for it one way or another, and so I think that's the sort of the dynamics of how these programs all interact with each other that we've sort of got to come to grips with in some of these the reality of some of these debates. Yeah, so the question was about high-income people who, in the data, appear not to have retirement plans. So a couple things might be going on there. One is it may not be counted as a retirement, so it wasn't a defined contribution plan, but it was like a pension or some other kind of a savings vehicle. Or they might have non-retirement savings, which is very common among higher income households, is they have retirement savings, but it's not in a retirement account. So it's not in a 401k or those kinds of accounts. So they have a lot of assets. They're just not retirement-specific assets. For the average person, they have retirement savings and a little bit else. Like it's almost all in those sort of designated accounts.
Okay. Would you please join me in thanking Michael for coming and presenting today?
Thank you.
And while we don't give you a big stipend for coming, we do have a token gift for thanking you for your presentation. Thank you very much.